Hello, traders. I am recording this video after a really big market move down. We've got a lot of people out there that are absolutely freaked out by what's happening in the market. We also have a lot of people who are very, very happy. If you've been following my advice, you've been short the market, you've been taking profits along the way. You're probably in a cash position right now, or you should be very close to one because drops like this eventually find support. But this is a very tricky period to trade because we've got an incredible amount of volatility in the marketplace right now. So I want to do this video. My slides are not going to be fantastic or awesome. My point was I wanted to teach you how to trade this environment, and I wanted to get the information out to you quickly because there's an opportunity this week. And so I'm going to show you some of the techniques that you can use for options trading. If you're not an options trader, then this video is not going to be worth a lot to you because you've got to be able to take advantage of high option implied volatilities. So let's get to it. This is the crash strategy. I've done similar videos in the past. Back in the COVID crash of 2020, you can go back and watch those videos, see how we were trading when the world was falling apart. So when we have a market sell-off, we need to identify what's the nature of the drop. What caused this drop? And there are a couple of really big reasons for the market to fall, and you need to identify what those sources are. The biggest one by far is credit. Credit is a nasty critter, and you have to treat it very, very carefully. Yes, I traded the 2008 financial crash, and that was the spookiest moment I've ever been in. I don't want to go back to that place, and we're not at that place right now. Credit conditions tend to smolder and they brew over time. And you need to know what's the source of the credit issue. Is it consumer credit? Well, if it's consumer credit, that's usually going to lead to an economic recession and consumers are going to cut back on their spending habits. It's not going to be anything disastrous unless corporations have been making lots and lots of bad loans, like we saw in the 2008 financial crisis. That was largely because people were buying homes that they couldn't afford. So the whole system could have fallen apart. But consumer credit generally is not going to be that which causes a complete market crash. Those are usually going to lead to recessions. And right now, we do have consumer credit tightening. Interest rates are high on a relative basis. We also have credit card delinquencies on the rise. So that's something that we need to watch. We've got banks announcing earnings in about a week or two. And so we're going to be watching carefully what those bad loan write-downs are. Municipal debt is another source. You've got all these municipalities who continue to spend money. Many of them are broke. It's a problem that can fester very, very quickly, and it translates into state problems as well. So states also have mountains and mountains of debt. According to the U.S. Constitution, states are not supposed to run any debt or deficits. They're supposed to have a balanced budget because our founders knew that the chain is only as strong as the weakest link. So if you had 50 states who were basically broke and overspending, that was going to damage the entire nation's creditworthiness, which incidentally, I do feel that there is a huge issue on the provincial level for China. These provinces have been spending way too much money. They're out of money. They're not paying their employees or their municipal workers right now. And that's a problem that China's going to be dealing with. Things could unravel there very, very quickly. Next is sovereign debt. Now, that's when the debt is held by the actual country. You've seen lots of, they call them banana republics. South America is known to just scrap the system and issue a new currency and start all over again. And the United States has not gone through that. That's why we are the world's reserve currency. We've always made good on our debts. So once the country is in jeopardy, things can escalate very quickly. And the true tell for that is when the country has to issue more debt, you start to see interest rates really rise very quickly. That means that they're having to pay more and more to attract investors to buy that debt. And investors are requiring a higher rate of return because they see that risk is elevated. And once you start getting over that double digit, 10%, 11%, 12% borrowing rate, things can fall apart very, very quickly. So you do want to watch what sovereign debt levels are around the world. I know I was watching the EU in 2010, 2011. They called them pigs. That was Portugal, Ireland, Italy, Greece, and Spain were some of the countries that had the highest debt levels. And when they had to issue debt to finance their governments, those interest rates were very, very high, which incidentally, the United States has $9 trillion to roll over in 2025. And those interest rates are going to stay relatively high. That is a lot of money, and that is a lot of debt that they have to sell. But I don't see an imminent credit crisis right now on this drop. It's not the reason for the drop. Could it turn into a credit crisis a half a year from now, a year from now? It's going to be determined by what happens globally with other countries, and we'll get into what's happening right now. But sovereign debt is a completely different animal, and that is where you can start to see dominoes fall from one country to the next to the next. They call that contagion. We haven't seen that, but the global banking system is very intertwined. So if by chance the US is thinking that, oh, China's got debt problems, it's not a problem, that's their problem. We don't care what happens to China. Well, that's the second largest economy in the world, and we absolutely should care what happens in China. We should keep close watch of what happens there because it could be a domino effect that starts to impact many, many other countries. And the US has a boatload of debt. So does Japan, third largest economy. So does the entire EU. So debt levels are extremely high, and there's always this house of cards, and there's always this uncertainty and this possibility of what could be. Now, this has been going on for a long time, so I'll also keep this in mind, is that all these countries keep printing money and keep printing money, and it's kind of been, I'm okay, as long as everybody's playing nice in the sandbox, we're going to be fine. But as soon as somebody oversteps their bounds and prints too much money or gets out over their skis, it's like, okay, now all of a sudden we have a problem with this because somebody has stepped out of line, and that's when the wheels start to wobble. And then it's a concern. Gee, what is our exposure to a possible credit problem in China? Or what's our exposure if we have an issue in Europe? And I'll tell you that in 2010 and 2011, there was huge demand for US dollars and there wasn't much demand for Euro dollars. And the US basically had to work out currency swaps with the EU and the ECB, whereby the US was buying Euro dollars and issuing dollars just to stabilize their banking system. So everything is intertwined. That's the key point. I'm not seeing anything imminent right now on the credit front, although we are always skating on thin ice with where credit levels are currently. So that's not the cause for this big drop, though. Corporate debt is another possible problem, although that is the private sector. If the companies are very large, and I'm not talking banks specifically, I'm talking about large corporations, could be the large automakers, for instance. If the governments feel that they are strategic, they will bail out these companies. If they don't feel that they're strategic to national security, then They will let these companies go bankrupt. So the government will step in to help bail them out when needed. And we saw that in 2008 and 2009 with the big three auto manufacturers. So there are a number of different credit concerns that can arise. It's important somewhat to know which type of credit problem we're dealing with. And when you start to see credit issues surface, you're going to see just these gigantic drops in banking stocks. JP Morgan Chase, Goldman Sachs, Bank of America, Capital One, anybody that's issuing a lot of debt, those are going to be the companies. And I mean, when these stocks fall, they are going to hit these 20, 30% air pockets like we did back in 2008. Shearson Lehman, Bear Stearns. It was really incredible to watch the bottom fall out. Very unnerving. That's not what's happening right now. If you see a credit issue, credit concerns, then you just have to go to cash and just step aside until the market starts to find support, and hopefully it does. And then you'll be watching for some signs of that support, like capitulation lows and all. It takes time for those problems to filter through and for any plan, whether it's TARP or whatever the bailout plan is, whatever it is, it takes time for that base to form and for buyers to finally feel comfortable that they can start coming in and allocating some capital that the storm has passed, so to speak. And then it takes a year or two or three. Everybody's treading very cautiously after a credit issue. So credit, different animal. You're not going to be using this strategy when that happens. And then your investment and your trading really starts to take on much more of a fundamental perspective because you need to pick your stocks very, very wisely. So we also get some events that cause big market sell-offs. They can be war. Most wars see a temporary market impact. The U.S. hasn't been attacked for a long time. 9/11 was the closest that we had come to it. But yes, if the U.S. is invaded or goes into a major war with a major developed nation, yeah, it will have more than a temporary effect. But for the most part, in my lifetime, in the last 60 years, wars have not had a big market impact. They have a temporary impact and you get a decent market sell-off. If that market sell-off accelerates and you see a big drop in a very short period of time, wars are going to be resolved, and that's an opportunity for us to take advantage of that drop. So that's one of those where this strategy is going to work. You also have disasters. A disaster could be like the COVID-19 pandemic. That was a disaster. We've never seen anything like that. We didn't know how this was going to be resolved. It could be massive tsunamis in certain countries like Japan. It could be earthquakes, all sorts of disasters. The flash crash, it could be something to do with the national power grid. It's something big has happened, something unexpected, a black swan type of event. But that disaster is going to be relatively temporary. We're going to figure out ways. It's by nature horrible, but we're going to find ways to resolve that. And that's something that can be overcome. And that big market drop is going to present some opportunities for us. I put political as one of the events. And right now, what spooked the market is we have a technical sell-off in the market. I consider it to be very mechanical, and it's related to tariffs. The United States has announced that it's going to impose tariffs of 10% or higher on all of our trading partners. And in some cases, those tariffs could go up to 20, 30, 40% for some of these countries. And the issue that we had right now was that no one was expecting President Trump to go through with this. They thought, oh, these are just blind threats, and he's going to put it out there, and then he's going to retract them, he's going to negotiate them. And it was always this it's going to be better than feared mentality, and the market was very, very stubborn and just didn't want to believe that he would go through with his plan. Well, he did. And so now we're seeing the repercussions of that. We've got a big, massive, deep drop in the market. Market's off about 20%. It's dropped about 12% in the last 3 days. So this is an absolute shock. And when you get events like this, what happens is, again, there's a domino effect, and there's something called a mechanical sell off. And what mechanical means is, if you can just imagine that you've got people who have been buying for a year or two and their average cost is very, very low. And let's say that they generally have this entry point and that's their stop out point. The market should stay above this level. And as long as it does, we're fine. But if it falls below this level, we're going to stop out of our positions. We're going to start reducing risk. And those types of stops, if there is heavy support, you're going to see that stop taken out. And then you're going to see continued selling because of that sell stop, so to speak. And as you're breaking these major technical support levels, you're also attracting more short sellers. And so as you fall through them, it feeds on itself. And if you think about what large trading institutions do, is they use mathematical models constantly. So they're always trying to price where they feel fair value is. There are a lot of option trades that are involved. They're using leverage, they're using margin. And so a lot of this is done programmatically. And if you figure what the standard deviation move is from the current market price, okay, well, here's X probability of that event occurring. Oh, a 2 standard deviation event. Now we're into the 90 percentile of it not happening. Oh, there's a 3 standard deviation possible event. Well, that's even less likely happening. And so from simply an option premium, an option selling standpoint, you've got corporations, institutions, I should say, trading institutions who have been selling that far out of the money option premium. So they collect it, and 95% of the time, there's not a problem with those options ever going into the money. So it's like this cash machine that just keeps generating money. And you can see, if you look at VIX or VXX, those both measure S&P 500 option implied volatilities for near term, say the next week, 2 weeks, 3 weeks out, and also for longer term periods, a month, 2 months out. And so when you see these option implied volatilities starting to spike, then those firms that are short volatility, they have to start reeling that volatility in. They have to start adjusting and buying that volatility. And oftentimes what they will do is they will sell the wings, meaning they'll sell puts and they'll sell calls. Well, the proceeds that they got from the call sale are negligible once the market starts to really sell off. And now they have to buy those puts back in. Well, that means that they're buying options. They have to buy those puts in, and that makes those puts more expensive. And that's when you start getting an explosion in option implied volatilities. And you also have, on big market sell-offs, you've got an explosion. There's uncertainty in the marketplace. You have explosion in these option implied volatilities because the odds that the market's going to move big higher are very great. The odds that the market is going to move lower are also very great. There's lots of uncertainty. And so right now, if you look at this, you could say, oh, are the tariffs really going to be that bad? Are they going to cause a big crash in the market for the next year or two? And you're going to have factions of people who say, yeah, I think the tariffs are going to be bad. And I think the market is longer term going to go down. You'll have other people who come in and say, I don't think that this is going to happen. This is actually not that disastrous. It's just a market reaction. We had lots of asset managers recently who were fully into the market, fully allocated. There's a Bank of America survey that was done recently that showed that asset managers who were surveyed had record low levels of cash. They are all into the market. That means they have very little firepower when there is a dip to allocate more money. That means that the dips are going to be more severe and they're going to be stronger because there's no safety net there. There's no buyers. There's no cash left to buy with. And it also means that when they're fully allocated, what are they going to do? Well, they might be able to weather the first 10% drop in the market, but after that, they're going to be thinking, I need to reduce some risk. And they're all heading for the exits at the same time. And then you get that market drop. And so that's another thing to keep in mind when you're looking at the current market drop is what are those asset managers doing on a short-term basis? So those are some of the potential causes, and we need to look at how far did the market drop and in what amount of time. So speed is very, very important. And if you look at any of the research that I do on price action analysis, our ability to predict price movement is the highest when we know that one side or the other is very motivated. And we can see that in the price action on a sell-off like this. You're going to see stacked red candles with very little overlap. And you're going to see that on very, very heavy volume. And those moves are going to be dramatic. So the strategy that I'm going to be teaching you right now needs that speed. So I want to get from point A to point B very quickly. So if this is a 20% market drop, I'm not talking about a market drop that took 6-8 months to happen. Okay, that's not fast enough for me. That is a gradual drift lower. That is a Chinese water torture recession type move. That's not what I'm talking about here. I'm talking about the price action that you saw in February and March of 2020, when the entire government shut down, when the world shut down, when COVID was at its peak. Go look at the S&P 500 and look at that chart. That's the kind of move that I'm talking about here. So speed is very important, and you want to see that horrific big sell-off in the market. And that also is what's going to jack up those option implied volatilities. I'm not talking about a 2% move. I'm not talking about a 5% move. I'm talking about a 20% move in the course of a month or two. That's what we've got. That is a really big move. If you tell me we just fell 12% in the last 3 days, that's a big move, okay? People are freaking out right now. So that's the type of magnitude that we want. And what about the duration of the move? Well, because we're talking about a very fast move, we're not talking about 6, 8, 10, 12 months, okay? So we want a very short, swift correction in the market. And those, again, if it's not credit related and there's nothing no credit issues right now that are absolutely apparent, well, then it's got to be an event of some type that's causing this type of aftershock. And so that's what we're going to be looking for right now. What kind of support do we possibly have? I mean, that should be your first question. Is there anything that we can kind of hang our hat onto? So let's take a look at what the market's done on a daily basis. And you can see the light blue line is the 50-day moving average. The darker blue line is the 100-day moving average. And the black line is the 200-day moving average. So you can see that that's the 200-day moving average right there. We've absolutely annihilated that. We just fell through it. And we also stayed below it for quite a while. So that was a sign of persistent selling pressure. As soon as we tried to bounce and get back above the 200-day moving average, no go. Market sold off and it tested this horizontal support level. And then we got a tiny little bounce in here. The market was weak to start with, and we had global issues. So right now, tariffs are at the forefront, and that is what everybody is focused on. But if you look at growth in Asia, you look at growth in Europe, everywhere around the world, very, very soft, hardly any growth, we're talking less than 1% growth. Okay, well, higher interest rates are not particularly good when you've got global growth struggling. Central banks have started to see signs of a recession, and those central banks have been easing. So they're less worried about inflation, which has been a concern, and they're more worried about the threat of a recession. Well, here's what happened when President Trump announced the tariffs on Tuesday. And again, everybody's thinking, oh, they're not going to be as bad as we expected. And you can see that the S&P 500 has dropped from 560 down to almost 500. Massive, massive sell-off. So are the tariffs going to be that horrible? Is the whole world just going to stop doing business? Probably not. Are these companies worth that much less money because of what happened on Tuesday? Probably not to this extent. Okay. If this is going to have a longer term lingering effect on the market, yes, I believe that's very possible. This to me is mechanical, meaning that these programs started to feed on each other. People hit the panic button. They started just selling their stocks. Institutions started selling their stocks. You had up here asset managers who are willing to weather a 10% market drop are not in that camp any longer. They're reducing risk because they didn't have any cash, and there weren't that many asset managers who had cash available to buy this little bounce anyway. So they're easily flushed out of their positions. I believe that we're going to see a pretty decent market bounce in here in the next day or two. And that's what we're going to be looking at. But where are we going to find that support? Where is the market support? So you can see I've got a weekly chart up here. And again, we've taken out, this is a 100 week moving average. You can see that the moving averages are of little importance to us because they've all been breached. There's some horizontal support that we can see here around 500. We can see some support around the 460 level on the SPY. Okay. Well, those are interesting levels. We're going to a monthly chart. You just keep zooming out and seeing what you've got on a monthly basis. Well, this 480 level, I think, is going to be a support level that I would hang my hat on. I would say we're probably not going to go much below that in the next week or two. I don't really care what happens after that because I'm going to be watching price action. I'm going to be making all of my decisions based on what I see in front of me, not based on what I think. So yes, 480 could be a support level. You can see we've got an upward sloping trend line here. Why didn't you connect it to that tail down there? It's too long. Okay, this is a massive bounce in here. And if I connect it there, then I'm going to have all sorts of really steep trend lines in here. And I would prefer to use this low off of that bounce and connect it here. And that gives me a better gauge and it's not super steep. But that 480 level to me was a prior high. We pulled back and now we've broken through it. That one looks like a pretty decent level where the market should be able to find temporary support over the course of the next few weeks, couple of months, and then we'll see how all the tariff situation plays out over the course of the next 6 to 8 months. I feel that we're probably going to see bearish conditions for probably the next 6 months. I'm thinking maybe by October, depending on what the economic impact looks like and how the economic numbers start coming out, I think by then we might start to get a sense of the true impact of the tariffs, and perhaps we get a little bit of a year-end rally into the end of 2025. And then again, lots of information coming in, time to digest that news and to see if the damage is really as big as the market has priced in, or perhaps maybe things are actually looking better than that. Maybe they've changed the entire tariff landscape. We don't know, and we're not going to guess. All I'm trying to take advantage of is something that I feel is a massive overreaction right now, and that's really mechanically driven. And these firms are having to adjust everything on the fly, like quantitative models that are all program generated. Well, when they get whacked out and they start getting margin calls from their brokerage firms, they're not mincing words. They've got to adjust. They have to buy back in their shorts. They have to sell their long positions. They don't have any choice in the matter. And that is especially true when you get these moves that happen extremely quickly, because now all of a sudden, from an odds standpoint, from a probability standpoint, you're into something that's called a fat tail distribution. It hardly ever happens, but when it happens, it causes all sorts of chaos for the reasons that I've already described to you. So there really weren't any visible signs of support except for that 480 level that I would use on a monthly basis. And it's not really that critical or important. Is that the level that everybody's going to be looking at? I don't know. At least I have an ability to gauge how much farther the market might fall. I think it's probably 250 S&P 500 points. I'm recording this before the futures markets are open on Sunday evening. I have no idea where the futures are going to open. None. So if we see a big drop in the S&P 500 overnight, it's okay. I'm going to show you a strategy where we're just going to sit back and watch what happens Monday morning, but we'll be ready to act, and we're going to be watching for a possible bounce. But here's the problem that we have right now is that we're all trying to look for a strategy that might work, and we feel like, yeah, the move could be legitimate on the way down. There could be some real impacts of higher tariffs on inflation and consumption, and that's going to play out over the course of the next 6 or 8 months. So that's certainly true that there are longer term implications to it. But how do I trade that? Do I get short right here? Oh, it feels so uncomfortable to short right here after such a big drop. You're also going to have the other side of the coin where there are going to be institutions and companies with dry powder who are viewing this as a massive overreaction. Hey, there should be a short-term bounce in here. I want to play it. I want to be looking for it. The market doesn't go straight up or straight down. This has been a big knee-jerk reaction. There's going to be a buying opportunity in here. And when I see it, I'm going to snap it up. I'm not going to overstay my welcome. I'm going to be in there and I'm going to play it because I see this as a really good opportunity. So the issue that we have is that do not go out there and buy call options. That's the stupidest damn thing you can do. And bring up a chart of VXX or VIX, and that is showing you what option implied volatilities look like. They're sky high. Okay. You do not want to be buying those options right now, because if you are right and the market starts going up, what's going to happen is you're going to see that implied volatility actually come out of those call options, and it's going to take quite a while before you even make money on that trade. And this is true of longer term options and shorter term options. On short term options, that is just the worst thing you can do, because those things are full of option implied volatility and time decay. So if the market muddles around for just a week or so before we get this big bounce, that option implied volatility is going to collapse, and so is the time premium. because the market hasn't moved. So buying short-term options, please do not do that. Short-term call options, that is for idiots. I hope I've made that point really clear, because there are going to be a lot of people who try that and they are going to get their asses handed to them. Could you go out further in time? You could do anything. My God, you could do any damn strategy you want, So people are going to ask me 1,000 different questions. Can I do this? And what about that stock? And what do you think about that? You can do anything you want. Okay. I got to keep this video to within 45 minutes. So I'm going to tell you what I'm going to be doing. The other issue that we have, so we've got super expensive option implied volatilities. You can't be an option buyer. You have to be an option seller. Well, if I'm looking for a big market bounce, and if I feel that this is a big overreaction by the market, well, then I got to be a seller of puts, right? That's the only that's the only strategy that I can be doing, is I have to be a put seller. Okay, cool. Well, I'll sell some puts. I'll find some stocks I really like and I'll sell some puts. The other problem that we have with options when the market pulls back like this is, what do the market makers do? They freaking spread out the bid ask. I mean, you can take the largest oil tanker in the world that can barely pass through the Panama Canal, and that's how wide the bid ask spreads are. The market makers don't want to trade unless it's on their terms. So again, you get these huge 50-cent wide bid-ask spreads, dollar wide bid-ask spreads, $2 wide bid-ask spreads. They've jacked up the option implied volatility, so the options are super expensive, and they've widened out the bid-ask spreads. Well, you shouldn't be trading in that kind of environment because the odds are stacked against you in the largest possible way. All right, well, I'm kind of finding out what I can't do, and maybe what I can't do is going to lead me to what I can do. And there is an opportunity. So where are our odds the highest? Well, we know we need to focus on selling naked puts. Okay, so what I like to do is I like to find stocks that are relatively cheap in price. Okay, I'll explain it a little bit later, but I'm really looking for a conservative play here. I'm not looking to hit a home run. I'm looking for very, very high probabilities of success. And as I go through this, I'm going to tell you another thing, and that is that we are small traders. I'm small potatoes. No matter how big I'm trading, if I'm $1 million or $2 million or $3 million, I'm a small fry. Okay, I'm nothing. So why do I need to compete with the big boys? I don't need to, and I shouldn't compete with them. I should find opportunities where it suits me, where I can get plenty of size done to make a really decent return, where they are not interested in playing. It's too small for them. They can't even wet their whistle on what I'm doing. So they're not going to be in here muddling around with me. But I'll also tell you that if this video is viewed by 4,000 people and each of them are looking to do a 10 lot or a 20 lot, that's 40,000 contracts. That's 80,000 contracts. The option markets are not going to hold that type of liquidity. So focus on the lesson so that you can do this and you can find this. That's the whole point of this. That's the whole point of everything that I do in all of my videos is I'm trying to teach you, because when these opportunities set up, I'm going to be doing it for me. And I don't give a rat's ass, quite honestly, if 4,000, 5,000 other people can follow me or not. I'm going to do it to generate money as a professional trader. So learn these lessons, and this trade example that I'll end with is going to not be there because you got too many damn other people trying to follow the trade. But there are other opportunities out there similar to this. So focus on selling naked puts. Avoid spreads. Why do I need to avoid spreads? Spreads limit my risk. Spreads reduce my margin requirement. One of the reasons you need to avoid spreads is because if the bid ask spreads are a mile wide, now you got two legs. You have two legs to the trade. I have to navigate two gigantic bid ask spreads. The other problem with spreads in a volatile market like this is where in the hell is my order being routed? There's no centralized marketplace for an option spread. And most of the firms send it off to a market maker and they get paid for that order flow. And the market maker doesn't have to represent your bid ask on a spread. It's just out there virtually. The market maker is going to look at it and decide if they want to take the other side or not. And only when it is to their utmost advantage will they fill you on that spread. Well, that doesn't sound like a particularly fair game to me either. And the market's in complete chaos, stuff flying all over the place. I don't have my spread represented nationally so that lots of other traders and lots of other institutions can look at that spread and they can see that I bid 50 cents for this spread and they might be interested in it, but it never appears there because it's out in this vacuum. It's just sitting and residing for market makers to take a look at and to decide if they want to fill it or not. The other reason that I don't want to trade spreads is the high option implied volatility. Well, I'm trying to sell high option implied volatility. Yeah, but I'm going to have to buy high option implied volatility as well. So if I'm doing a bullish put spread, for instance, and I sell the $100 put and I buy the $95 put, that $95 put is going to be freaking expensive. It's going to be sky high. So I don't want to do spreads. Got to navigate two bid ask spreads, and I don't want to be buying high option implied volatility. And if something goes wrong with that spread and I have to buy it back, how will I even be able to get out when the option bid ask spreads are a mile wide? Nobody wants to touch them. It's toxic. So if I'm just selling a naked put, I have one bid ask spread that I have to navigate. And those bids and asks are displayed nationally. Those are all buyers and sellers. So my trade is going to be represented and other people are going to be able to see my bid or my ask on a single leg option. Awesome. I have to find stocks with relative strength. So when the market has been tanking, plunging, plummeting, well, what stocks are out there that are actually holding up quite well? Well, if they're in the S&P 500, there are baskets of stocks that are sold. And yes, some stocks in that S&P 500 are going to be stronger than others, and we'll be able to search for that relative strength. But in general, as soon as you're in these large indices, those stocks all tend to sell off. Now, if you go into other stocks that aren't in those big indices, and we're small traders, then we can find opportunities there. But look for that relative strength and then check the fundamentals. Well, what does that mean, Pete? I'm not a fundamental analyst. Just look at the news. What has happened recently with the company? Think about it. Why might this company have been spared? The whole freaking market is falling apart. Everybody's so worried. But here's this one stock over here that's holding up really well. Huh? Why? And is there an opportunity for me there? Just by nature that it has relative strength, we know that institutions aren't counting it. They're interested in it. They're supporting it. For every seller, there's a buyer who's probably looking to accumulate a long-term position. Awesome! Market falling apart, stock treading water. All right. I like it. I've done a little research. I've read a little bit about the fundamentals. This is not a pie in the sky company. It's a legitimate kind of company, and they've got some good news surrounding it. So this stock, when the market has crumbled, has actually held up pretty well. I'm going to stay short term. Why am I staying short term? Because the market sell off and this dramatic drop that we've seen happened for a reason. Okay, large institutions feel that there's danger ahead. There's uncertainty ahead. Well, I'm not going to fade that. It's just that the market has pulled back too far, too fast. That's the only thing I'm looking at. That rubber band is stretched so far right now. How much farther can I stretch it? Not very much. Not very much, because it's already stretched so far, and then it's going to snap back. Okay, so I might be a little bit early on my trade, and that's okay because when it snaps back, the market's going to release, and this stock is going to continue to tread water or possibly move higher. And I'm going to be taking advantage of that decay in time premium, and I'm going to be taking advantage of a collapse in option implied volatility. And the stock should still be able to move higher because it's already shown me it has relative strength. So I'm afraid right now. There's a lot of uncertainty. How do I increase my odds even more? You don't sell an in the money option. You don't sell an at the money option. You go out of the money so that the stock has to still pull back. It's been strong relative to the market, and the market has fallen, let's say 20%. What are the chances that it's going to fall another 5 or 10% in the next week or two? Not very high when it's already made a move of that magnitude. If that stock has been so strong and it has treaded water when the market has pulled back 10% in a week, what if the market pulls back another 10%? This stock is probably going to be right there. It's not going to all of a sudden, everybody's not going to decide, oh my God, this stock, sell it, sell everything. No, it's already been strong. There's a bid there. Buyers are there. So what's the goal here? What am I trying to do? I'm trying to take advantage of this gigantic market decline, and I'm trying to generate some income for a couple of weeks. Let the dust settle, get my bearings, see how price action is playing out. So instead of just sitting on my hands right now, there's really a legitimate opportunity for me here. I'd like to generate a 5% return in 2 weeks. I'm going to be selling that really, really rich option implied volatility on the notion that number one, the market is going to bounce in here. And number two, the stock has already shown relative strength. It's going to continue to show relative strength for the next week or two. And I'm willing to buy the stock if I have to, but I'm probably not going to have to. So what I'm going to do is just in case this stock decides to fall apart, I'm going to hold half of the strike price in reserve. So if I'm selling a $20 put on a stock, I'm going to hold $10 in reserve because if I am assigned, I will be able to buy that stock on Reg T, 50% margin requirement. So I can take possession of the stock. Maybe I was just a little bit early on this, and maybe the stock does head a little bit lower and I get assigned on it, and then the market rebounds. That's cool. I don't have a problem with that. And I'm willing to accept the stock and I'm willing to accept those terms. So you should expect assignment. When people get into trouble, in this type of strategy is, like always, they over leverage. Oh, gee, maybe instead of holding half of the strike price in reserve, I'll just put up the exchange minimum margin requirement of 20%. And then, of course, lo and behold, the bottom of the stock drops out and you can't take assignment. You are forced to buy back those puts. You don't want to be in that situation. You want to have plenty of margin that you're working with. And instead of selling and putting up the exchange minimum margin requirement because Pete said he could make 5%, but if I sell and I use the exchange minimum margin requirement for this trade, I'm going to be able to make 20% in 2 weeks. This is a very uncertain market condition. And so you need to make sure that you are keeping your risk appropriate. And that comes from doing the appropriate type of size and making sure that if push comes to shove, you're able to take possession of the stock. So that's what I'm going to be showing you right now. And given that it's April of 2025, there are probably people going to be watching this a long time in the future. This is just one example. Okay. There are dozens of other opportunities out there. And that is what you should be spending your afternoon doing, is looking for these opportunities. In Option Stalker Pro, I'm going to use our custom search engine and I'm going to go through. These are the stocks that were returned. There are many other searches I can use. This is one example. And yes, you can go through and you can click through a lot of these, and you're probably going to find maybe 2 or 3 other good examples. I'm just giving you one example. So you just have to know what you're looking for. And I want relative strength on a D1 basis. I want relative strength on an H1 basis. Okay, the market has fallen apart. It's lost 10% or more in the last 3 days. That's the backdrop. But these stocks are strong relative to the market. Huh? Cool. They're probably not going to drop, even if the market drops another 5%. Maybe it's down 1%. Maybe it's down 2%. That sounds pretty good. I can weather that. Price of the stock. Because I'm not advocating doing spreads, and I've already explained why. If I sell naked puts on relatively inexpensive stocks, then it's easier for me to put up Reg T margins. So if I'm selling a $30 put, I've got to put up $15. If I'm selling a $500 put, I got to put up $250. So you can see that higher price stocks are not going to work as well for this. The lower price stocks are actually going to work quite well for this. So I've got a price of $1 to $30. Show me stocks that have option implied volatilities greater than 40. I consider anything over 35 to be fairly rich, fairly expensive. And I want those expensive options because then I'm able to sell them further out of the money. Show me a stock that's above the 200-day moving average. I showed you earlier the S&P 500 is way below the 200-day moving average, okay? These stocks have been able to preserve that support level. Nice. That tells me that they've got some buyers in there. The bottom has not fallen out like it has for the overall market. Option liquidity rating. These are liquid options, a -1, anything 0 or higher. You're going to be able to get 20, 30 contracts done, no problem. You start getting up into the 4 or 5 range on the option liquidity, then you'll be able to get 100 lots done. So yes, I wanted to make sure, excuse me, I just advanced that slide. So I've got to find a way to get back. And I'm looking at the previous slide so we can get back into these criteria. So yes, above the 200-day moving average. The only other criteria I had is show me a stock that's not announcing earnings anytime in the next 3 weeks. So from today, 3 weeks out, they're not announcing earnings. I need that time because I want to take advantage of time premium decay. And if I've got a company that's announcing earnings in 3 or 4 days, no bueno. There is no strategy here. Okay. I've got to be able to hold that position. And I do not ever, ever, ever hold over earnings announcements. So if I know that they're more than 3 weeks out, I've got the latitude to look at what some option strategies might possibly be because I'm really only looking to sell that premium a week, 2 weeks, 3 weeks out. I want to keep it as short in duration as I possibly can to take advantage of that bounce, implied volatility decay, time decay, all of those things. And because the market is sold off so hard, so fast, I don't want to be hanging out in this trade for a long period of time because there could be some longer term repercussions. And this could be a very legitimate move lower for the market. So after we get that bounce, it could be a failed bounce. And that could set us up with a great shorting opportunity. And that could materialize in the course of a couple of weeks. But I'll already be able to take profits on this trade even before then. And I'll be able to watch everything play out from the sidelines without even sweating because the scenario that you're going to see here is going to make so much sense that you're going to go, I wouldn't even sweat that trade. Perfect. That's exactly what we're looking for. If with very little worry, very little panic, I can get through the next couple of weeks and I can make a 5% return. Thank you very much. I'll take that all day long. That's the opportunity that we've got set up right here. So one example and one stock that you saw in that custom search that I ran was RKLB. Okay, bring up the chart, take a look at it. Hey, this is pretty nice. We've got a compression here. It's made a really nice run in here. This looks sound technically. We've got a support level right in here. Earnings after the close. The stock pulls back a little bit. Look at it compress. You saw me use the 200-day moving average as a criteria in custom search. What if I said, hey, show me a stock that's in a D1 compression? Would that be good? Hell yes. Absolutely. That's another variable I can use because when the market has been tanking and the bottom has absolutely fallen out, here's a stock that's in a compression. Ah, that's relative strength. Yes, it is. If you know what you're looking for, then you know the variables to use to find it. And then you can happen into these stocks and take advantage of these opportunities. So this stock is beautiful. Look, it's above the 200-day moving average. It's been holding up when the market fell apart in the last week. What did the stock do? It tested that moving average on Friday and went right back up. Bullish hammer. What market sell off? This is telling us that long-term asset managers, they've got a lot of stocks out there. They are way allocated. They've got hardly any cash to buy anything, and they're looking for stocks to sell to reduce risk. Are they selling this one? No, they like this one. They're hanging on to this one. They don't want to sell this one. They'll sell some of the other stocks, but they're not selling this one. And for those asset managers who might be selling this one, there are other asset managers saying, I will buy that thing all day long. And that's why it's been able to preserve that support level. So you've probably already looked at the strategy. I'm going to sell the RKLB April 17th, $13 puts for 50 cents. Okay, well, where's that come into play? That comes into play way below the 200-day moving average. You can see this horizontal resistance. That's kind of a horizontal support level. I'm comfortable with that, to be quite frank with you. When I look at the price of the stock and I go, 1637 is where it closed. $13 is a 20% move in 2 weeks. What are the odds that the stock is going to drop 20% in 2 weeks when it has weathered all of the market selling to this point? Market, blam, 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 blam. They're nailing everything. Everything's going down. Not this stock. There are buyers here. So all of a sudden, if the market decides it's going to have another 5% sell-off Monday, maybe it's a 10% sell-off next week, how far will this stock drop? Maybe it takes out the 200-day moving average. Okay. Is it going to drop down to 13? Probably not. Even if it drops to 13 and I sell the naked puts for 50 cents, my net cost on the stock is actually $12.50. I'm in at a really good price. Okay. And I can hang on to that stock position if I have to. And I've already told myself I'm going to put up $6.50, which you see here, half of the strike price, half of the $13 strike price. I'm going to hold it in reserve. That's $6.50. And I can buy the stock on Reg T. And if I divide the 50-cent credit that I want to get for selling that naked put in 2 weeks' time, that's almost an 8% return. Where else are you going to make that kind of money? So the stock has to drop 20% in 2 weeks. And that's only going to happen if the market has another, say, 10% drop. Even then, I don't see the stock dropping 20% in 2 weeks because it hasn't. I know there are buyers in it. These are the types of scenarios that you should be looking for. We're talking high, high, high odds of success. We're not talking speculation here. We're not talking pie in the sky. I think the market's going to bounce, so I'm going to go buy some calls. That's the stupidest damn thing you could ever do, okay? I think the market's going to tank, so I'm going to buy some puts. Stupidest damn thing you can do. So you should be in cash. You should be waiting. You should be watching. You should be evaluating. But there is an opportunity for us to make 5, 8, 10% in the next couple of weeks. So let's do it. What the heck? If I take a look at the options on RKLB, you can see they're 28 cents bid offered at 65 cents. That's the Susie Max oil tanker driving through the Panama Canal, through this bid-ask spread. You can see how wide these freaking options are. You get a little bit of a market sell-off on Monday. Maybe the stock drifts back down to the 200-day moving average. Boom. You get your 50 cents. Thank you very much. I might have to buy that stock at $12.50. Bring it on. I'll do it. And again, you could say, this is small potatoes, Pete. We can't all get in this trade. That's right. But on a stock like this, I'm sure if I were trading alone, I could probably put 100, 200 lot out there. They would take me out. If they see that it's at a decent price and it's shown nationally, they would take me out of that trade. It wouldn't be a problem. And I have to be able to split the bid-ask spread. But you're going to have to go find these opportunities yourself. They're out there. And so that really is the conclusion of my presentation. And let me go back to the last slide so that I've got, well, I think the show has ended, but we'll talk a little bit about the market, and I'll put my D1 chart up there. This move, if you think we're going to see another long candle like that, I got to tell you, if we see a long candle like this on Monday, we're going to see a long candle like that on Tuesday, and it's going to reverse that move. This is way, 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 way oversold. So look for really nice stocks that have had relative strength. You want to sell naked puts. You don't want to do spreads. You don't want to have to navigate two bid-ask spreads. You want to have your offer shown nationally so that other traders can take you out, and look for those stocks and sell way out of the money. This is a great opportunity. I'll mention to you that in 2020, I remember Google was trading at around $1,100. $1,100 is where Google was. We sold the $650 puts that were 2 or 3 weeks out. Okay, so Google would have to be halved for us to get into trouble. Google would have to be halved in 2 weeks for us to be in trouble. We sold those 650 puts. We made 5-7% in 2 weeks period of time. Just stock never even came close. I mean, I think it probably rallied from that point on. But when you start looking at scenarios like that, and if I would have tried to spread that trade off, I'll sell the 650 puts and I'll buy the 640 puts and I'll do that for a credit of $1. You're not going to get that dollar, okay? Because your trade's not out there represented in the public view. It's being held by these market makers, and they look at what their bid ask is on each one of those option legs, and they're like, no, I'm not interested in that. I'm not going to sell that for that. But if you go and you do one leg of the spread, then everybody can see it and somebody will take you out. And somebody did take us out on that particular spread. I think we sold the 650 puts, and I think we sold them for like $10 with 2 weeks left to go. $10. So there were people out there, and it's because all the option pricing is determined by auto quote and all these algorithms, and they cascade out based on those option pricing models of where that option should be trading. And yeah, they will take you out if you just have one leg of that spread shown. So naked put writing, great strategy. You don't get a lot of these opportunities. I've seen probably about 5 or 6 of them, I would say, maybe in the last decade, but they come on these very, very fast, very, very deep drops. It's some kind of shock to the system. You want to make sure that this is not credit related. So this is not a strategy that I was using in 2009 because the bottom was falling out. This is a strategy that you can use when you don't have a credit crisis, because if that house of cards ever implodes, you don't know where that floor is. You don't know where that support is. But if it's an event like this, you can be pretty confident that you're going to get a decent market bounce in here somewhere. Thanks so much for watching, everyone. Please leave your comments. Give it a thumbs up if this type of analysis is helping you. Help me reach other traders. Please share this video. I mean, this is a great strategy. You got other traders out there who are struggling to find their way right now. They don't know what to do after a big market drop like this. This is a really nice strategy that they can learn how to do. And trust me, once you put the spread on it, if you find the right stock, you're not going to sweat it at all. And you watch that volatility from the sidelines. 2 weeks later, you'll be paid, and we'll have a better idea where the market goes next. Trade well. We will see you soon.
Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education. So make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.